right about now. Again, welcome to our first quarter media briefing. We are releasing our report for today. I will be your moderator. I'm Erica Manasan, Senior Manager of Investment Sales. Before we start, please allow me to acknowledge and thank our media partners who are here with us today. Philippine News Agency, the Manila Times, Billionario, Business Mirror, COL Financial, Reuters, Bloomberg, Business World, GMA News Online, Malaya, Hospitality News Philippines, Philippine Hospitality Association, Philippine Star, and Nikkei Asia, and ABS-CBN. Today, our speakers will be covering the office market, residential sector, hospitality industry, and the capital markets. And before we begin, I would also like to acknowledge the presence of our Executive Management Committee at LPC. Our Executive Director for Investment Sales, Mr. Henry Cabrera, our Executive Director for Commercial Leasing, Philip Añonuevo, also an Executive Director for Commercial Leasing, Laila Ledonio, and Director for Research and Consultancy, Roy Amado Goles Jr. Our key speakers this morning, to let me introduce, Mikko Barranda. Mikko has been facilitating lease acquisitions and renewals, restructuring for 13 years in the metro and in emerging markets throughout the country. Our Commercial Leasing Director, Mikko Barranda. We also have with us Director for Investment Sales, Mr. Tam Angel. Tam has more than 10 years of real estate experience covering capital market transactions across the country, adept at helping local conglomerates, developers, and multinational companies strategize their real estate portfolios. Of course, our Director for Research and Consultancy, Mr. Roy Goles, leads our research team which offers a full suite of services from market research, project conceptualization, to highest and best use studies. All of these provide Roy a good grasp of the residential segment. And of course, last but not the least, our Director for Hotels, Tourism and Leisure, Mr. Alfred Lay, will be sharing his insights as well. Alfred leads a team of specialists in hospitality industry research, investment sales, and owner advisory, and has over a decade of experience in the hotels, tourism, and leisure industry. As we mentioned earlier, we have just released our Q1 2024 market report today, and our theme is Grace Under Pressure. This theme is something that we thought about due to our local market being tried and tested for the past couple of years, coupled with the very recent geopolitical tensions. Nonetheless, we note that fundamentals of the country are keeping us sound and buoyant. We see growing population, comparatively lower debt to GDP ratio, and better employment rates. We believe that we are well positioned in the mid to long-term outlook. Before we dive right in, just a quick recap of our 2023 or the last year's briefing, year-end briefing. On the office market, last year we posted 1 million square meters of office demand, the highest since the pandemic, and we saw the IT BPM, as usual, being the largest demand driver. This first quarter, we already posted 331,000 square meters of new space, and we'll be seeing a new main driver for that, which will be led by the traditional offices. We also see vacancy rates this quarter improve to 18%, a slight improvement from last year's 19%. For the residential market, last year, 2023, was a recovery year from them as we saw demand and product launches show high double-digit increases. This year, Roy will show us that the trend continues when it comes to decentralization from vertical projects in the metro to horizontal townships outside the capital region. Roy will also show us the increase in residential real estate loans, signaling continued growth across the residential market. For the hospitality industry, last year, we reported over 5 million international arrivals, surpassing DOT's targets for last year. This year, the first quarter posted the best first quarter performance thus far, and we'll discuss later if we can reach this year's DOT targets. For the capital markets, 2023, we saw 100 basis points rate hike at a high of 6.5%, leaving investors to maintain a cautious outlook as we see capital values traded sideways last year. Recently, April 8th, in its fourth consecutive meeting since October 2023, BSP maintained the key policy rate at 6.5%. Tam will show us later on how developers and the real estate market are coping up with high interest rates. And now we'll start the media briefing proper to introduce our first speaker, Director for Commercial Leasing, Mr. Mikko Barranda. He will talk about the office market. Mikko?
Good morning, everyone. Welcome and thank you again for attending our first quarter 2024 property briefing. We thought of starting this conversation with you on a positive note. Just to start the conversation, a few weeks back, we read an article published by the World Economic Forum that the Philippines has the potential to be a 2 trillion economy in less than 10 years, that is 2034. So what we wanted to put on screen is really some of the growth drivers, the engines which we believe will help us get to that $1 trillion goal. And all these growth drivers are interconnected with the property market. First is the revenues from the IT BPM sector. From 2016 at 20 billion, they closed 2023 at 35 billion US dollars. And with discussions we've had with the Association of the BPO industry, the aim is to grow that to 60 billion in 2028. Today, the industry itself represents 8% of the GDP. Hand in hand with that is the remittances that has kept on growing year on year. And as we know, most of the remittances are injected back in the market through acquisition of residential properties. And finally, in tourism, which we believe is a low-hanging fruit and so much potential, we've been saying that in most of the briefings we've had in the past. In 2019, the landmark year for the tourism arrivals was 8 million. That is the largest year that we've had as a country. And comparing that to other neighboring countries like Thailand, where they fetch close to 40 million, that number is really negligible and has a lot of potential. So what happened in the last 4 years is that the difference with the Philippines before and the Philippines today is that we are more interconnected due to all the infrastructure projects, all the airports that were modernized and created will really bring tourism to its peak, hopefully, as the DOT has set a large target for us. Now, just diving into the office sector specifically, which is what I'll be talking to you about today. In summary, we've seen a 25 increase in demand year on year. And we will try and attempt to dissect that demand for us to really appreciate the basket of gross of demand that we have that took place in the first 3 months. In terms of industries, it's all industries that have helped hand in hand to really bring us to that number. For outlook, supply remains persistent. There's still a lot of buildings, properties that are being injected this year. About 800,000 square meters will be completed in 2024. So that's still quite a lot for us to anticipate and just will take a bit more time for vacancy levels to really correct. And we'll show you a bit of our projections with that a little later. Now, diving into the demand itself, essentially record high single quarter demand, the most we've had in the last 4 years. So on these bar graphs represent the take-up quarter on quarter, and you will see that from 2020, 158, we are now at 331,000 square meters of leasing demand. We've actually also had side conversations with developers. One major developer has told us that for the first 3 months of the year, they are already 25,000 net demand, whereas the full 2023 numbers for them was only 20,000 net demand. So they could see the activity happening even in their own portfolio. And this particular developer is not only concentrated in the core districts, but they have their portfolio spread across Metro Manila. If you look at the growth drivers, all cylinders are working together, taking space. So BPO companies, despite whether they are hybrid, whether they are 70-30, 50-50, they are leasing space in the market. The POGOs, a lot of regulation has taken place, a lot of news about them, but we have encountered activity from that front. They have leased a few chunky deals for Q1 2024. And finally, the traditional offices, essentially these are all industries outside of POGO and BPO. One particular segment did stick out, which is government. So we've seen in previous years, there has been government activity, meaning many of the departments that are in 30-year-old buildings looking to relocate, modernize, upgrade, and a few of those large transactions did take place in Q1 2024. And as we can see in the pipeline, which we will show you later on, there are a number of other government agencies in the same boat now, scouting for new space, looking to upgrade their premises. So just for us to really understand the demand in more detail, we've attempted to dissect the 331,000 square meters. What we've noticed is the Pareto principle at work. Essentially, 80% of your consequences is attributable to 20% of causes. So there are 369 transactions, unique transactions that have taken place in Q1 2024, but only 81 of those, which represents 22%, has impacted the market greatly, has impacted the market 80%, or 76% to be specific. And those are the companies that have leased 1,000 square meters and above. The pie chart on the left of your screen will show you that these are the companies or the industries that have leased space above 1,000 square meters, where it really matters in terms of moving the market. The BPO industry is still a large proponent. But also, we've seen that 7 out of 10 or 70% of transactions that took place are companies that have not only relocated and taken the same amount of space, but most have relocated but taken more than what they have. So there's a lot of growth, there's a lot of new leases. For POGOs, generally when they lease buildings in the market, it's not because they're relocating from one office to another, it is also them taking new, fresh space. That is a different story when it comes to the traditional offices, or even government in particular. Many of the government agencies have let go of their large, old offices and has modernized, but has also equally signed up for the same amount of space. And that is where you see a lot of the, what we call flight to quality. So old buildings where traditional offices are today, they probably have spent 5 to 10 years, and now they see the opportunity to move to grade A prime buildings because of the opportunity pertaining to really commercial flexibility of what landlords are able to offer. Hence, we've seen a lot of these transactions take place in these buildings and in new properties, which are 5 years and below. Now, what gives us a lot of confidence is tracking the basket or our pipeline of deals in the market today. So as of the end of March, we have seen 580,000 square meters of live leasing demand, meaning that many of these transactions have told us that they want to lease space, and they want to lease space this year. Whether 30% or 50% of that gets transacted, that still gives us a lot of optimism that there's a volume in the market today. And we've broken that down according to how much of that are looking in Metro Manila and how much of that are looking in the provinces. So if you look at the Metro Manila, government, again, is one thing that we've noticed. A few large government agencies are looking to consolidate, many of them in very old buildings wanting to be in one massive property. Some are even having a hard time finding that property, just given the scale of the requirement they have. In the provinces, majority of demand are BPO companies looking for space. Now, just on the other side of the coin, talking about contractions, so companies that have let go of space. We have seen that number also go up at 147,000. But what we have observed is that in 2019, which was 5 years ago, companies during that time that signed leases were signing at the peak of the market. That was the peak of the market. They were signing rates above market because of the vacancy levels at the time were at its lowest. And we noticed that when companies sign up for space today or in 2019, they already are projecting headcount not for tomorrow but for the next 5 years. So when many of those leases started to end in 2023, they had a choice of whether keeping the space or rebalancing their portfolio. So many companies have looked at their footprint and have said, maybe some of us need to be hybrid. Maybe a few of us can actually consolidate in one big office. So we've seen them let go of space, not pre-terminate immaturely, but they've let go to really just have a better balance of what they need at the moment. And that is the story of what we're seeing. Hence, we've broken down how much of those transactions are leases that have naturally expired, meaning they have told the developer 6 months in advance, we are not going to renew, find a replacement, as opposed to companies that have said, we need to get out of this space tomorrow, even though we have 3 more years left in our contract. So very different story and very important to note when looking at contractions. Now, contractions and demand, essentially the number that is important to us at what is net demand. As of first quarter, it's 184,000, 14% in compared to the first quarter of 2023. But what we've always tried to take note of is we've been seeing this gap starting to widen. So essentially, more transactions, less contractions. In terms of the number of supply, what the buildings, square meters out there, these blue bars represent the amount of space in these markets today. So there are still a lot of office supply in districts all over Metro Manila, even in the provinces. Hence, it will take time for us to be at a certain point where vacancy levels will be single digit. But what is important is we're seeing sustained demand. And it is just a matter of eating up through the amount of supply that developers have committed years back and just finishing those buildings in more recent years. Finally, just in terms of forecast, this is an attempt for us to understand when will the market turn in terms of Metro Manila or countrywide. Given the amount of buildings or supply today, which is 3.2 million, we have forecasted how many contractions there will be this year and how much more space will be injected in 2024. Essentially, if we're able to hit what we've said in 2023 year-end, 1.1 million, 5% more than last year, then it will take us to 2027, 2028 for the market to turn. But what we've also tried to stress is we need to look at vacancy on a per district basis rather than look at it as Philippine world on a nationwide level. Because other districts today are already at 9-10% today. So the prudent way to look at that is to see it from each of the districts. But this gives us a lens of how long it will take for us to really cover the amount of supply in the market. With that, thank you so much. I will pass the mic back to Erica to introduce the next speaker.
Thank you very much, Mikko Barranda of Commercial Leasing Department. Just a quick rundown or recap of what has been reported recently. Again, overall demand in Q1 was recorded at 331,000 square meters, a 25% increase quarter on quarter, which is the highest quarterly performance since the pandemic. We have also seen the trend break where IT BPM is the largest demand driver. Now, in Q1, traditional offices take the lead with government offices the highest in that demand, particularly in the Metro Manila. Again, that demand is influenced by tenants wanting to go or consider flight to quality with regards to looking at office spaces. Again, also notably, contractions or office space being vacated by tenants have increased from the previous quarter, but we noted that these are 80% natural lease expiries or non-renewals. Notably, net demand, the trend is upwards, or there is a growth in overall net demand. Vacancy rate this Q1 is 18%, slightly better from 19% last quarter. And as we heard earlier, single-digit vacancy rates may seem to be in our reach by 2028, hopefully.